Hi, Dan Paladin here, and I'm going to show you some illustrations regarding comp since this is the implementation weekend. So let's go over this, and this is cost analysis, which I do go over with every buyer, and this will show the different scenarios when it comes to comp on how it can be handled, so they're educated and prepared for whatever may come along with offers that they like to, or properties they like to look at, and whether it offers comp or no comp, so it's not a surprise somewhere down the road. Very important that your lender is involved out the gate to go over these different scenarios that are possibilities and how it can be handled to mitigate those costs. So option one, seller paid, nothing changes, business as usual. So I'm not going to spend much time on this one, because this is just, hey, seller's paying it, done, no big deal, nothing changes. Section 2, let's just say I'm using 900 as a purchase value scenario. I'm using 2% as a comp scenario to the buyer, so that's the buyer agreement. And in this case, we're going to say the seller is not paying. How can we offset that with the buyer? Doesn't want to come out of pocket for it. So we add the 2% to the price. Seller still nets off of their 900, so no harm, no foul. Shouldn't be an issue for a seller to do that. We're assuming 20% down, 734.4. Current rate as of this date, 6%. And their payment is 4403, slightly above, of course, the 4317 under option 1. Total cost to close, 212,418. So nothing real fancy there, but hey, we're just putting it on top. It's still going to be called commission, not a concession. That's got to be very clear. Write it up that it's going to be a comp, you write it up in advance, so you write it up normal. You write it up like option 1. Okay? So we don't write this up as 2% seller concession for comp. Doesn't work that way. Okay, number 3, no comp, buyer's going to pay, doesn't mind, and has the funds, and so that's what we have here. So well, let's take a look at that. So back down to the same, it's going to look a lot like option 1 at 900. Everything's going to be the same, 6%, 4317 payment. Differences in the cost to close compared to option 1, because we've got the 18,000 tacked onto the standard costs. So that's how if you add 18,000 or 208, you get the 226. So again, works if the buyer has the funds. Option 2 is great. Hey, I don't have the funds, stick it on the loan. Okay, great. And obviously there are things in between. What if it's a split? Some by the buyer, some by the seller. So there are other options. These are not the only two ways to go. It's fluid. We can make it work one way or another to try to make it, as cost effective for the buyer. So very important to keep us involved out the gate, keep the buyer educated so they don't get scared and run away later. Who you work with matters. So feel free to reach out to me and we can discuss how this can work in your business. Thank you.